Your stop loss is making you poor. That's a bold claim, but let me explain. 90% of traders set their stop loss based on gut feelings, emotion, or their personal pain tolerance, not cold, hard market logic. And that's a one-way ticket to blowing up your account. Here is a little insight from Wall Street. Stop loss and take profit aren't crystal balls. They're not prediction tools. They are statistical risk management tools. Think of them as the protective barrier for your mathematical edge in the market. If you stick around, I'm going to reveal the three-point protocol used by hedge funds to eliminate confirmation bias and trade with the discipline of a machine. This isn't about guessing, it's about executing a plan. The core purpose of a stop loss and a take profit is to remove you, the emotional second-guessing operator, from the trade once it's live. It's the automation of discipline. Let that sink in. Once you enter a trade, your job is done. The plan is set. It's the algorithm's turn to take over. Now, for the harsh truth. If you find yourself constantly adjusting your stop loss, moving it further away, because it's about to turn around, or you're inching your take profit closer because you're scared of giving back gains, you're not trading. You're negotiating with the market. And negotiation is the single most irrational, destructive act in trading. You are letting fear and greed dictate your actions, completely abandoning whatever strategy you thought you had. This is where most traders fail. They have a plan, but they can't resist the urge to meddle. Your SLTP levels are your commitment to your strategy, your shield against your own emotional weakness. So, how do we fix this? By adopting the three-point protocol. This is a systematic, data-driven approach that takes your emotions completely out of the equation. Let me ask you a question. How do you decide where to place your take-profit order? If you're like most traders, your answer might involve a mix of hope, a little bit of fear, and maybe a dash of pure guesswork. You might think, wow, this trade feels like a home run. Let's aim for the moon. So you set a take-profit that's miles away from your entry. Or perhaps you've been burned before, so now you get nervous at the first sign of green and snatch your profits too early, leaving a huge amount of money on the table. This is the classic trader's dilemma: greed versus fear. Greed makes you set your take profit way too far, hoping for that one life-changing trade. The problem? The market rarely delivers those, and you end up watching your profitable trade reverse all the way back to your stop loss. On the flip side, fear makes you set your take profit way too close. You lock in a tiny win, feel relieved for a second, and then watch in frustration as the price continues to soar without you. Both of these emotional approaches are gambling, not trading. They are completely detached from the one thing that actually matters, your system's statistical performance. So how do we escape this emotional roller coaster? The answer is to replace hope and fear with cold, hard math. We need to build our take-profit strategy using our system's win rate and its expected value. This isn't about predicting the future. It's about playing the probabilities over the long run. The goal isn't to maximize profit on any single trade, but to maximize the profitability of your entire trading system over hundreds of trades. Let's break down what this means. Your trading edge is a mathematical formula, not a gut feeling. It's defined by your expected value, or expectancy. This formula tells you how much you can expect to make on average for every dollar you risk. The formula is expectancy. Win rate x average win. Loss rate x average loss. If this number is positive, you have a winning system. If it's negative, you have a losing system, no matter how good it feels. Notice how your take-profit target directly influences this formula. A larger take-profit increases your average win, but it almost always decreases your win rate, because the price is less likely to travel that far. A smaller take-profit does the opposite. It increases your win rate, but shrinks your average win. The sweet spot is finding the balance that gives you the highest positive expectancy. It's a trade-off, and you need data to find the right balance for your specific strategy. Let's walk through a concrete statistical example. Imagine you've backtested your trading system over the last 200 trades. You find that if you aim for a simple 1-to-1 risk-to-reward ratio, meaning you risk 100 to make 100, your system wins 60% of the time. Let's calculate the expectancy. Your win rate is 0.6 and your loss rate is 0.4. Your average win is $100 and your average loss is $100. Now let's see what happens when greed takes over. You think a 1-to-1 ratio is boring. I want those massive wins. You decide to start aiming for a 1-to-3 risk-to-reward ratio, risking $100 to make $300. That sounds amazing, right? But here's the catch. To hit a 1-to-3 target, the price has to move 3 times further in your favor. This is much less likely to happen. After testing this new approach, you discover your win rate plummets to just 30%. Let's run the numbers on this new high-reward system. Your win rate is now 0.3 and your loss rate is 0.7. Now let's take it one step further. What if chasing that 1-to-3 ratio dropped your win rate to 25%? This is a very realistic scenario. Let's calculate the expectancy now. 0.25 x 300, 0.75 x 100. That's 75 dives, 75, which equals 0. Your system is now break-even, at best. You're taking a massive amount of stress, enduring long losing streaks, all for nothing. And if your win rate drops to 20%, you're now officially running a losing system, all because you were chasing a potential profit that looked good on paper instead of focusing on the statistically proven expected return. This brings us to the most important rule. You must calculate your expected return, not just fantasize about potential profit. Your job as a trader is to be a risk manager and a statistician, not a fortune teller. Your take profit should be a direct output of your system's tested performance data. It's not about what you hope the market will do. It's about what your historical data tells you the market is likely to do. So how do you put this into practice? It starts with meticulous record-keeping and backtesting. Go through your last 100 or 200 trades. For each trade, record what the maximum favorable excursion was. That is, how far did the price move in your favor before reversing? Once you have this data, you can start to see patterns. You might find that 70% of your winning trades reach a 1.2R profit, but only 30% reach a 2R profit. This data is gold. It allows you to find the optimal take-profit level that maximizes your system's expectancy. Maybe you discover that the sweet spot for your strategy is a 1.5-to-1 risk-to-reward ratio, which yields a 55% win rate. Your take profit is not a static number, it's a dynamic variable that you must solve for. Stop setting your TP based on a random level on the chart or a feeling in your gut. Instead, let your own trading data guide you. Test different risk-to-reward ratios and see how they impact your win rate. Find the combination that gives you the highest, most stable positive expectancy. This data-driven approach removes the emotional poison of greed and fear from your decision-making process. It transforms trading from a stressful gamble into a methodical business. You'll have more confidence in your plan because it's based on facts, not fantasy. Going to explore a quantitative approach that the pros use to stay consistent and manage risk like a machine. This is the secret to surviving and thriving in the unpredictable world of trading. So let's start with a common problem. Have you ever felt like your trading performance is a roller coaster? 1 month you're on top of the world, and the next, a few trades wipe out a huge chunk of your profits. You might have a great strategy, you might be disciplined with your entries and exits, but if you're not sizing your positions correctly, you're essentially gambling. The core issue is that most traders use a fixed position size. They might decide to trade one standard lot, or 100 shares, or zero point 0.1 Bitcoin on every single trade, regardless of the market conditions. Think about it for a second. Is the market the same every day? Of course not. Some days are quiet with very little price movement. Other days are wild and volatile with prices swinging dramatically. Using the same position size in both a calm market and a volatile one is a recipe for disaster. Why? Because it leads to uneven, unpredictable risk. In a calm market, your stop loss might be relatively tight, say 20 pips. With a one-lot position, that's a certain amount of risk. But in a volatile market, that same 20-pip stop loss might get hit in seconds. To give your trade room to breathe, you might need a wider stop, say 80 pips. If you're still using that same one-lot position size, your potential loss on that single trade is now 4 times larger. You didn't change your strategy, but your risk just exploded. This inconsistency is what kills trading accounts. You're exposing yourself to massive losses during volatile periods without even realizing it. This is where the quantitative approach comes in. We need to stop thinking in terms of how many shares or how many lots, and start thinking in terms of how much am I willing to risk. Professional traders and quantitative funds don't guess. They calculate. They aim to keep their cash risk constant for every single trade. Let's say you decide, based on your account size and risk tolerance, that you are comfortable risking $1,000 per trade. That $1,000 is your constant, your anchor in the stormy seas of the market. The goal now is to adjust your position size so that no matter where your stop loss is placed, a losing trade will cost you exactly $1,000, no more, no less. This is called volatility-adjusted position sizing. So, how do we measure this volatility? Quants have a few favorite tools for this, and they're readily available on every trading platform. The two most common are the average true range, or ATR, and the standard deviation. The ATR is fantastic because it measures the average true range of price movement over a specific period. A high ATR means the market is volatile, with big price swings. A low ATR means the market is calm. Let's put this into practice. Imagine you've identified a great long setup. First, you determine where your stop loss should be based on technical analysis, perhaps below a recent swing low or a key support level. You don't just pick a random number of pips. You let the market structure tell you where the logical invalidation point is. Now, let's say, in a calm market, this logical stop loss is 30 pips away from your entry price. In a more volatile market, for a similar setup, the logical stop loss might be 90 pips away because the price swings are much larger. Here's where the magic happens. We use a simple formula to keep our $1,000 risk constant. The core principle is this: a shorter stop loss means you can take a larger position size. A wider stop loss requires you to take a smaller position size. Let's do the math. Your risk is fixed at $1,000. In the first scenario, your stop loss distance is 30 pips. To calculate your position size, you would divide your cash risk by your stop loss distance in dollars. If each pip for a standard lot is worth $10, then a 30-pip stop is a $300 risk. To get to our target $1,000 risk, we can take a larger position. The formula is position size, shark total cash risk, stop loss distance in pips, value per pip. This ensures that if the 30-pip stop is hit, you lose exactly $1,000. Now consider the second scenario, the volatile market. Your stop loss is 90 pips away. Using the same formula, you'll find that you need to take a much smaller position size. Why? Because each pip of movement now carries more weight against your wider stop. A 90-pip stop on that same large position size from the first trade would represent a $3,000 risk. By reducing your position size, you bring the risk right back down to your comfortable, predefined $1,000. Do you see the power in this? Your risk is now stable, it's consistent, it's predictable. Every time you enter a trade, you know your absolute maximum loss. This has a profound psychological impact. It removes the fear and greed that often drive bad decisions. You're no longer terrified of volatility, you simply adapt to it. You're no longer tempted to oversize your position in a quiet market just because you're bored. This method also keeps your expectancy consistent across all trades. Expectancy is a key concept in trading. It's the average amount you expect to win or lose per trade over the long run. By keeping your risk, the R in your risk-reward ratio, constant, you are standardizing one of the most important variables in your trading equation. If you have a strategy that, on average, provides a 2-to-1 reward-to-risk ratio, this method ensures you're always risking 1 R to make 2 R. In our example, you're always risking $1,000 to potentially make $2,000, regardless of whether the market is whipping around or moving slowly. This consistency is the bedrock of a professional trading career. Let's recap the process. Step 1. Determine your fixed cash risk per trade. This could be 1% of your account, 0.5%, whatever you are comfortable with. Let's stick with our $1,000 example. Step 2. Identify your trade setup and determine the logical placement for your stop loss based on market structure, not an arbitrary number of pips. Step 3. Measure the distance from your entry to your stop loss. Step 4. Use this distance and your fixed cash risk to calculate the appropriate position size. A wider stop means a smaller size. A tighter stop means a larger size. By implementing this volatility-adjusted sizing model, you transform your trading from a game of chance into a game of skill and statistical probability. You are now managing your risk like a hedge fund manager, not a retail gambler. You're protecting your capital, which is job number 1 for any trader. You're ensuring your longevity in the market, and you're building a stable foundation from which your trading account can grow steadily and consistently over time. This isn't just a fancy trick. It's a fundamental shift in mindset. It's about respecting the market's power and adapting to its ever-changing conditions. Stop letting volatility dictate your profit and loss statement. Start using it as a tool to inform your decisions and standardize your risk. This single change can have a more significant impact on your trading results than finding 100 new indicators. We're talking about the fallacy of moving your stop loss. I know what some of you are thinking. Isn't that just active trade management? Aren't I supposed to adapt to the market? It sounds logical, doesn't it? The market moves, so you move with it. But here's the hard truth. Manually moving your stop loss, especially moving it farther away from your entry price, is one of the most statistically illogical things you can do. It's an act of hope, not a strategy. And in the world of trading, hope is the most expensive commodity you can buy. Let's break this down. Every trade you take, if you're serious about this business, should be part of a system with a positive expectancy. This means you've done your backtesting. You know that over a large sample of trades, your strategy produces more profit than it does losses. This statistical edge is your entire business model. It relies on a few key pillars: your entry criteria, your take-profit target, and your stop loss. These 3 points define your risk-to-reward ratio. For example, you might have a system where you risk $1 to make 2. Your backtesting proves that this setup, with these exact parameters, is profitable over time. Now, what happens the moment you manually move your stop loss? Let's say the price starts moving against you. It gets dangerously close to your predefined stop. The panic sets in. That little voice in your head starts whispering, "It's just a fake out. It's going to reverse any second. If I just give it a little more room to breathe, it will turn around and hit my target." So you drag that stop loss down. You've just changed your risk from $1 to maybe 1.5 or 2 or even more. In that single instant, you have completely shattered the statistical foundation of your trade. The system you so carefully backtested is gone. The positive expectancy you worked so hard to prove vanished. You are no longer executing a proven strategy. You are now gambling. You have single-handedly converted a calculated business risk into a pure emotional bet. You've left the world of probabilities and entered the casino of hope. Think about the logic behind it. Your initial stop loss was placed there for a reason. It was likely set based on a key market structure level, a recent low, a support zone, a moving average. Its purpose was to be your line in the sand. It represented the exact point where your trade idea, your initial thesis, becomes invalid. If the price reaches that level, it means the market conditions have changed. The reason you entered the trade is no longer valid. So if the market structure has shifted enough to threaten your original stop loss, what does that tell you? It tells you your trade thesis is already broken. The story you told yourself about why the price would go up has been proven wrong by the market itself. So why on earth would you double down on a failed idea by increasing your risk? It's like a ship's captain seeing an iceberg saying, "My initial course was wrong," and then deciding to speed up and steer closer to it. It makes no sense. The correct professional response when the market invalidates your thesis is simple, but not easy. Close the trade. Accept the small managed loss that your system was designed to handle. Then you step back. You reassess the new market conditions. Maybe there's a new trade setup forming. Maybe the best move is to do nothing. But what you absolutely do not do is negotiate with chaos. You don't bargain with the market. The market doesn't care about your feelings, your account balance, or your hopes for a turnaround. It will do what it's going to do. Your job is not to argue with it. It's to react with discipline. This leads us to what I call the sniper's protocol. Think of a highly trained sniper. They spend hours, maybe days, setting up their position. They calculate wind speed, distance, and trajectory. They have a single, precise plan. Once they have their target locked and all parameters are set, they don't second-guess themselves when it's time to pull the trigger. They execute with flawless discipline. After the shot is fired, they don't run after the bullet trying to adjust its course mid-air. The work was done beforehand. The execution is just a follow-through. That is how you must approach your trades. The real work, the analysis, the strategy development, the backtesting, is all done before you ever risk a single dollar. When you enter a trade, you are executing a predefined plan. Your entry, your take profit, and your stop loss are all part of that plan. This is the sniper's principle. Set it and forget it. Let me be crystal clear. Once your trade is live, with its profit target and stop loss in place, your job is done. Close the laptop. Go for a walk. Read a book. Do anything other than stare at the chart, letting your emotions get the better of you. Any manual interference after the trade is placed is not management. It is self-sabotage. You are reintroducing the weakest link in any trading system: human emotion, greed, fear, hope, panic. These are the enemies of profitability. Successful trading is the art of designing systems that systematically eliminate your own flawed human instincts. We are not wired to be good traders. Our brains are designed to avoid pain and seek pleasure, which in trading translates to cutting winners short out of fear of them reversing and letting losers run in the hope they'll come back to break even. A mechanical set-it-and-forget-it system bypasses this faulty wiring. It forces you to adhere to the statistical edge you've proven through research, not the emotional roller coaster you feel in the moment. The only exception, the only time you should ever touch your stop loss, is to move it in the direction of your trade to lock in profits. A trailing stop. For example, once the price moves significantly in your favor and breaks a new level of structure, you might move your stop loss up to your entry point, guaranteeing a risk-free trade. Or you might trail it behind the price to capture more of a strong trend. Notice the key difference. This is a pre-planned, systematic rule, and it is always done to reduce or eliminate risk, never to increase it. It's a defensive maneuver, not a hopeful plea. So I have a challenge for you. I want you to truly feel the power of this approach. Here's a simple 3-point protocol I want you to test. First, open a demo account. This is crucial. We're removing the fear of losing real money so you can focus purely on the process. Second, define a simple, non-negotiable trading plan. It can be as basic as, I will buy when the price crosses above the 50-period moving average, I will place my stop loss at the most recent swing low, and my take profit will be twice the distance of my stop loss. Write it down. These are your rules. Third, execute this plan for the next 20 trades. And here is the most important part of the challenge. Once you place a trade with its stop and take profit, you are forbidden from touching it. Set it and forget it. You either get stopped out for a small, predefined loss, or you hit your take profit. There is no in-between, no early exits, no moving the stop. I guarantee that after those 20 trades, you will see a profound difference. Not necessarily in the profit and loss, that depends on the market and your specific strategy, but in your state of mind. You will experience the difference between the frantic anxiety of emotion-driven trading and the calm confidence of machine-grade discipline. You will feel what it's like to be in control of your actions, even when you can't control the market. You'll understand that successful trading isn't about brilliant predictions. It's about brilliant execution of a simple, robust plan. Once you feel that sense of control, that liberation from the emotional prison of chart watching, you will never want to go back to the old way of trading again. You will finally understand that your greatest edge in the market isn't a secret indicator or a guru's hot pick. It's your own unwavering discipline. Thank you so much for watching. If this video resonated with you, please hit that like button. It really helps the channel out. And if you're serious about transforming your trading, make sure you subscribe and turn on notifications so you don't miss our future content. Give the Sniper's Protocol a try on a demo account and let me know in the comments how it feels. Until next time, trade with a plan and trade with discipline. Ever heard the saying, the definition of insanity is doing the same thing over and over and expecting a different result? In trading, we have our own version of this. It's subtle, it's tempting, and it's the single most destructive habit a trader can develop. I'm talking about the cardinal sin of breaking your statistical logic, manually moving your stop loss. Think about it. You've done your homework. You've analyzed the charts, identified a high probability setup, calculated your position size, and set your entry, take profit, and stop loss levels. Your entire trade is a carefully constructed system built on a statistical edge. You have a positive expectancy. This means that over a series of trades, you are statistically likely to come out ahead. Your stop loss isn't just a random number, it's the bedrock of that system. It's the point where you've predetermined that your trade idea, your thesis, is wrong. It's your safety net, your risk management, your discipline made manifest. Then the market moves against you. The price inches closer and closer to your stop loss. Panic starts to set in. That little voice in your head starts whispering, just move it a little further. Give it some room to breathe. It's going to turn around, I just know it. So you drag that stop loss down. You give the trade a little more space. And in that one single click, you have just obliterated your entire statistical foundation. You've taken a well-designed, positive expectancy system and turned it into a pure, unadulterated gamble. Let's break down why this is so catastrophic. Your initial stop loss was placed at a specific technical level for a reason. Maybe it was just below a key support level, or on the other side of a moving average, or at a point that would invalidate the market structure you were trading. That level represents the boundary of your thesis. If the price breaches that level, your reason for entering the trade is no longer valid. The story you told yourself about where the market was going has been proven wrong by the market itself. By moving your stop-loss farther away, you are essentially negotiating with chaos. You're saying, okay, I know my analysis said this was the invalidation point, but I'm going to ignore that because I feel like it might turn around. You're substituting objective analysis with subjective hope. Hope is a beautiful human emotion, but it has absolutely no place in a trading plan. Hope is not a strategy. When you move your stop-loss, you're not managing the trade. You're just increasing your potential loss. Your 1R risk suddenly becomes 2R, then 3R, as you chase the trade down, praying for a reversal that may never come. Here's the hard truth you need to accept. If the market structure has changed enough to make you even consider moving your stop-loss, your trade thesis is already invalid. The battle is lost. The correct move is not to widen your defense and take on more damage. The correct move is to accept the small managed loss you planned for, close the trade, and live to fight another day. Get out, reassess, find a new high-probability setup. Do not, under any circumstances, negotiate with a losing position. A small, controlled loss is just a business expense. A large, uncontrolled loss is a devastating blow to your account, and more importantly, to your psychological capital. Think of it like this. Imagine you're a sniper. You have a target, a clear line of sight, and you've calculated the windage and elevation. You have one shot. You take the shot. You either hit the target or you miss. If you miss, you don't start running after the bullet, trying to nudge it back on course. That's absurd, right? You accept the outcome, you analyze what went wrong, you recalibrate, and you prepare for the next shot. Trading should be no different. This is what I call the sniper's protocol. The sniper's protocol is ruthlessly simple. Set it and forget it. Once you've entered a trade with your predefined parameters, your entry, your stop-loss, and your take-profit, your job is done. You let the market do its thing. Your system is now in control. You've outsourced the execution to a disciplined, unemotional machine. Your plan. Any manual interference after this point is not management. It is self-sabotage. You are introducing the weakest link in the entire system. Human emotion. Greed, fear, hope, ego. These are the enemies of profitable trading. Successful trading is not about being a genius who can predict every market turn. It's the art of designing robust systems that methodically eliminate your own flawed human instincts. Your ego wants to be right. It hates taking a loss, so it will tempt you to move that stop loss to avoid the sting of being wrong. But a professional trader knows that being wrong is part of the game. A single loss means nothing. It's your performance over hundreds of trades that matters, and the only way to ensure long-term profitability is to maintain a positive expectancy by rigidly sticking to your risk parameters on every single trade. Now, some might argue, what about actively managing a trade? What if the market shows signs of reversal before hitting my take profit? Shouldn't I move my stop to break even or trail it? That's a different conversation. Moving your stop-loss to lock in profits, like moving to break even once the trade is 1R in your favor, or using a trailing stop to capture a strong trend, is a valid risk management strategy. That's defense. What we're talking about is moving your stop-loss farther away from your entry, increasing your initial risk. That's not defense, that's desperation. The rule is simple. You can move your stop in the direction of the trade to reduce risk, but you can never ever move it against the trade to increase risk. So how do you build this machine-grade discipline? How do you kill the emotional saboteur inside you? You have to prove the concept to yourself. I want you to try something. I call it the 3-point protocol. It's simple. 1. Define your trade setup with a clear entry signal. 2. Define your invalidation point and place your stop-loss there, no exceptions. 3. Define your target and place your take-profit there. Once these 3 points are set and the trade is live, you do not touch it. You close the chart. You walk away. You let the plan play out. I challenge you to backtest this three-point protocol. Open up a demo account where there's no real money on the line and execute your next 50 trades using this set it and forget it method. Log every single one. Don't interfere. Don't watch the candles tick by tick. Just let your predefined plan execute. At the end of those 50 trades, compare the results to your typical emotion-driven trading. Look at the difference in your equity curve. Look at the difference in your stress levels. You will see the undeniable mathematical power of discipline. You will experience the calm and control that comes from having a system and trusting it. Once you feel that sense of control, that liberation from the emotional roller coaster of watching every price fluctuation, you will never trade the old way again. You'll understand that the real game isn't about outsmarting the market. It's about mastering yourself. Discipline is the bridge between your goals and your accomplishments. Don't let a moment of emotional weakness tear down the bridge you've worked so hard to build. Stick to your plan, respect your stop loss, trade like a machine. Thanks so much for watching today. I hope this brings some clarity and helps you build the discipline you need to succeed. If you found this helpful, do me a favor and hit that like button and subscribe for more content on building a professional trading mindset. Drop a comment below and let me know if you've ever been guilty of moving your stop loss. Let's start a conversation. Stay disciplined, and I'll see you in the next video.